You know what nobody's talking about right now? The fact that we just crossed a threshold that historically only happens once every few decades. And I'm not being dramatic here. I'm talking about a specific market condition that's appeared exactly 3 times in the last 50 years. And each time, what followed was absolutely explosive. Let me paint you a picture of what's happening right now. Central banks around the world just reported their 15th consecutive quarter of net gold purchases. 15 quarters. That's nearly 4 years of relentless buying. But here's what makes this different from every other buying cycle we've seen. The pace is accelerating. In the third quarter alone, central banks added over 200 tons to their reserves. That's not a typo. 200 tons in 3 months. Now you might be thinking, okay, central banks buy gold, that's what they do. But let me show you something that should make your hair stand on end. When you map out the buying patterns, there's a specific inflection point that appears right before prices go parabolic. It happened in the late 70s, it happened in 2008, and it's happening right now. The pattern looks like this. First, you get steady accumulation. Central banks quietly building positions. Then you hit a phase where the buying becomes aggressive. Not just steady, but accelerating. And finally, you get what I call the mania phase. That's when price discovery breaks down completely, when the market realizes that physical metal is genuinely scarce, when paper contracts start getting questioned, when the whole structure of the gold market fundamentally shifts. We just entered that third phase. Let me show you the evidence. The COMEX, which is the primary exchange where gold futures trade in the United States, just saw something remarkable happen. The ratio of paper claims to physical gold hit levels we haven't seen since the financial crisis. We're talking about over 100 paper claims for every ounce of physical gold in the vaults. Think about that for a second. 100 people holding contracts that say they own gold, but there's only 1 actual ounce sitting there. Now, under normal circumstances, this isn't a problem. Most people settle in cash. They're just trading the price movement. They don't actually want the metal. But we're not in normal circumstances anymore. Delivery requests are spiking. In the last 6 months, physical delivery demands have increased by over 40% compared to the same period last year. People are saying, I don't want cash settlement. I want my gold. And here's where it gets really interesting. The LBMA in London, which is the other major gold trading hub, is seeing the same thing. Their vault inventories have been declining steadily for 18 months. Not dramatically, not in a way that makes headlines, but consistently. Month after month, metal is leaving the vaults, going into private hands, going into central bank reserves, disappearing from the available supply. You want to know what this reminds me of? There's a story from 1979 that most people don't know. Right before gold went from $200 to over $800 in a matter of months, there was a quiet period where something similar was happening. The Hunt brothers were accumulating silver, which everyone knows about. But what people forget is that gold was experiencing the exact same dynamic. Physical tightness, rising delivery requests, declining exchange inventories. And then one day, the market just snapped. Price discovery broke down. People realized that the paper market was a fiction, that the real market was in physical metal. And when that realization hit, the price didn't just go up, it exploded. We're talking about a 400% move in less than a year. Now, I'm not saying we're going to see a 400% move tomorrow, but I am saying that the conditions are eerily similar. The same structural tightness, the same acceleration in central bank buying, the same divergence between paper and physical markets. Let me give you another data point that nobody's connecting. Mining production has been essentially flat for 5 years. Despite gold prices being at or near all-time highs, miners aren't finding new deposits. The easy gold has been mined. What's left requires massive capital investment, years of development, and increasingly complex extraction methods. The average grade of gold ore being mined today is less than half what it was 20 years ago. That means you have to move twice as much rock to get the same amount of gold, so you've got flat supply. Accelerating demand from central banks, declining exchange inventories, rising delivery requests. and a paper market that's stretched to the breaking point. What do you think happens next? But here's what really keeps me up at night: the geopolitical dimension. Because this isn't just about supply and demand in a vacuum. This is about a fundamental restructuring of the global monetary system. And most people have no idea it's happening. China and Russia have been working on this for over a decade, building alternative payment systems, reducing their dollar reserves, accumulating gold. And now, the BRICS nations are openly discussing a gold-backed trade settlement system, not a gold-backed currency, which would be too provocative, but a settlement system where trade between member nations could be balanced using gold. Think about what that means. If you're a country that's been forced to hold dollars to conduct international trade, and suddenly there's an alternative, what do? You start diversifying. You start buying gold. You start reducing your dollar exposure. And that's exactly what we're seeing. Foreign holdings of U.S. Treasury securities have been declining. Not collapsing, but steadily declining. And where's that money going? Into gold, into hard assets, into anything that's not a claim on a government that's running trillion-dollar deficits. Now, let me talk about something that affects you directly. Because this isn't just about central banks and geopolitics. This is about your purchasing power, your retirement, your ability to maintain your standard of living. The official inflation numbers say we're at around 3%, but anyone who actually buys groceries or pays rent knows that's not reality. Real inflation, the kind you experience in your daily life, is running much higher. And here's the thing about inflation. It's not a bug in the system. It's a feature. It's how governments reduce the real value of their debt. It's how they make their obligations manageable. The United States has over $35 trillion in debt. That number is so large it's almost meaningless. But here's what makes it real. The interest payments on that debt are now over $1 trillion per year. That's more than we spend on defense, more than we spend on Medicare. Just the interest payments. There are only two ways out of that situation. You can grow your way out, which would require sustained economic growth rates we haven't seen in decades. Or you can inflate your way out. You can let the currency lose value so that the debt becomes easier to service. And guess which option is more politically palatable? So when I look at gold, I'm not just seeing a commodity. I'm seeing the market's vote of no confidence in the current monetary system. I'm seeing smart money positioning for what comes next. And what comes next is a repricing of hard assets relative to paper claims. Quick aside here. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description. Covers how to get physical gold into your retirement account without tax penalties, how the process actually works, what the real costs are. Worth checking out if that's relevant to your situation. Anyway, back to where this is headed, because the mania phase isn't just about price going up. It's about a fundamental shift in how people think about money and value. Let me tell you about what happened in Weimar Germany. Everyone knows the story of hyperinflation. Wheelbarrows full of cash to buy bread. But what people don't talk about is the phase that came before the hyperinflation. There was a period where the currency was losing value, but slowly, where people could see it happening, but it wasn't dramatic enough to change behavior. And during that phase, there was a massive transfer of wealth from people who held paper assets to people who held real assets. The people who owned land, who owned businesses, who owned gold, they came through the crisis relatively intact. The people who held bonds, who held savings accounts, who trusted the system, they were wiped out. And the transition from the slow phase to the fast phase happened almost overnight. One day, people were concerned but not panicking. The next day, the currency was collapsing. Now, I'm not predicting Weimar-style hyperinflation. The United States is not Weimar Germany. But I am saying that the dynamics of currency debasement are the same, and the protection mechanism is the same. Real assets. Things that can't be printed. Things that have intrinsic value. Gold has been money for 5,000 years. Not because of tradition, not because of superstition, but because it has properties that make it uniquely suited to store value across time. It's scarce, it's durable, it's divisible, it's recognizable. And most importantly, it can't be created by governments. That last point is crucial, because in a world where every major central bank is running negative real interest rates, where money printing has become normalized, where fiscal discipline is a quaint memory, You need something that exists outside that system, something that can't be debased, something that maintains its purchasing power, regardless of what governments do. And the market is starting to figure this out. Not the mainstream market. Not the people watching financial news and trusting the official narratives. But the smart money. The people who understand how the system actually works. They're moving, quietly, deliberately, building positions in physical gold. You can see it in the premiums. Physical gold coins and bars are trading at significant premiums to the spot price. That spread has been widening. In some cases, you're paying 5 to 8% over spot just to get physical metal. That's not normal. That's a sign of tightness, a sign that the physical market is disconnecting from the paper market. You can see it in the delivery times. Order physical gold today, and depending on the product, you might wait weeks. Not because of production issues, but because of demand. Because dealers are struggling to source metal. Because the refineries are running at capacity and still can't keep up. You can see it in the behavior of sophisticated investors. Family offices, the people who manage money for ultra-high net worth individuals, have been increasing their gold allocations, not to 2 or 3%, which used to be standard, but to 10, 15, even 20% of portfolios. These are people who have access to the best information, the best advisors, the best opportunities, and they're choosing to hold significant amounts of gold. Why? Because they understand what's coming. They understand that we're in the late stages of a debt supercycle, that the policies that got us here can't get us out, that something has to give. And when it does, you want to be holding assets that can't be printed, can't be debased, can't be inflated away. Let me give you a specific example of how this plays out. In 2008, during the financial crisis, gold initially sold off. People needed liquidity. They were selling everything. Gold dropped from over $1,000 to below $700 in a matter of months. And everyone said, see, gold isn't a safe haven. It goes down in a crisis just like everything else. But then something interesting happened. While stocks took years to recover, gold bounced back in months. And then it kept going. By 2011, it had more than doubled from the crisis lows. Why? Because people realized that the response to the crisis, the money printing, the bailouts, the zero interest rates, all of that was going to debase the currency, and they wanted protection. We're seeing the same setup now, except this time, the debt levels are higher. The money printing has been more extreme. The distortions in the financial system are more severe, and the geopolitical tensions are more acute. So when the next crisis hits, and it will hit, the response is going to be even more aggressive. More money printing, more bailouts, more currency debasement, and gold is going to be the beneficiary, not because of speculation, not because of momentum, but because it's the logical response to a system that's broken, a system that's running on borrowed time and printed money. Now, here's what makes this moment unique. We're not in a crisis yet. The stock market is near all-time highs. Unemployment is relatively low. Consumer spending is holding up. On the surface, everything looks fine. But beneath the surface, the structural problems are getting worse. The debt is growing faster than the economy. The deficits are expanding. The currency is being debased. And the smart money is positioning for what comes next. This is the mania phase. Not because prices are going parabolic yet, but because the conditions for a parabolic move are being set. Because the structural tightness is building. Because the paper market is getting stretched. Because the physical market is getting tight, and because more and more people are starting to understand what's happening. When gold was at $300, nobody cared. When it hit $1,000, people started paying attention. When it crossed $2,000, it made headlines. And now, as we push toward $3,000 and beyond, the narrative is shifting. From gold is a barbarous relic to maybe gold has a place in a portfolio to I need to own gold. That shift in narrative is what drives the mania phase. It's not about fundamentals anymore. It's about psychology. It's about fear of missing out. It's about the realization that the old rules don't apply, that the system is changing, that you need to adapt or get left behind. And here's the thing about mania phases. They last longer than anyone expects. They go further than anyone predicts. Because once the psychology shifts, Once people start believing that something is going to keep going up, they find reasons to justify higher prices. They find new narratives. They find new catalysts. And the price keeps climbing until it doesn't. I'm not saying gold is going to go up forever. Nothing goes up forever. But I am saying that we're in the early stages of a move that could be historic. That could rival what we saw in the 70s. That could fundamentally reset the relationship between gold and paper currencies. The question isn't whether gold is going higher. The question is how much higher and how fast. And the answer to that depends on how quickly the market realizes what's happening, how quickly the physical tightness becomes undeniable, how quickly the paper market breaks down, how quickly the narrative shifts from gold is doing well to gold is the only thing that makes sense. We're watching a slow-motion train wreck in the global monetary system. The tracks are buckling, the brakes aren't working, and everyone's pretending everything is fine. But the people who understand what's happening, they're not pretending. They're preparing. They're buying gold. They're getting out of paper assets. They're positioning for a world where the old certainties no longer apply. And that's what the mania phase is really about. It's about the transition from the old world to the new world. From a world where paper claims were trusted to a world where physical assets are king. From a world where governments controlled the narrative to a world where the market imposes discipline. From a world where inflation was transitory to a world where currency debasement is permanent. Gold isn't just going up because of supply and demand. It's going up because it represents an alternative, a way out, a store of value that exists outside the system. And as more people realize that, as more capital flows into gold, the price is going to reflect that shift. Not gradually, not predictably, but explosively. So, when I say we just entered the mania phase, I'm not talking about irrational exuberance. I'm talking about a rational response to an irrational system. A system that's printing money with no regard for consequences. A system that's accumulating debt with no plan to pay it back. A system that's debasing the currency and calling it policy. The smart money sees this. The central banks see this. The family offices see this. And increasingly, regular people are starting to see this too. They're looking at their savings and realizing it's losing purchasing power. They're looking at their retirement accounts and realizing they're denominated in a currency that's being systematically devalued. They're looking at the future and realizing they need protection. And that's what's going to drive the next phase of this move. Not speculation, not momentum, but genuine demand from people who understand what's happening and want to protect themselves. People who realize that the old playbook doesn't work anymore, that buy and hold in stocks isn't enough, that bonds are a guaranteed loss in real terms, that cash is being debased, and that they need something real, something tangible, something that can't be printed. That's gold. That's always been gold. And that's why we're entering a phase that's going to surprise everyone who isn't paying attention. Because the market is about to reprice gold relative to everything else. Not because gold is going up, but because everything else is going down in real terms. Because the currency is being debased. Because the system is broken. Because there's no other option. Hold tight. Because what comes next is going to be historic. The mania phase isn't the end. It's the beginning. The beginning of a fundamental repricing of value. The beginning of a new monetary era. The beginning of a world where gold isn't just an investment. It's insurance. It's protection. It's the only thing that makes sense in a world that's lost its mind. The train is leaving the station. The question is whether you're on it or watching it go by. Because once this move really gets going, once the mania phase kicks into high gear, there won't be time to catch up. The premiums will be too high. The availability will be too limited. The price will be too far gone. This is the moment, right now. When the smart money is positioning and the crowd is still asleep. When the opportunity is still there for people who understand what's happening. When you can still act before everyone else figures it out. Don't wait for confirmation. Don't wait for the mainstream media to tell you it's okay. Don't wait for prices to go even higher before you believe it's real. Because by then, it'll be too late. The mania phase rewards the early movers, the people who see what's coming before it arrives, the people who understand that the greatest opportunities come when everyone else is still skeptical. We just crossed the threshold. The mania phase has begun. And what happens next is going to reshape the financial landscape for a generation. Make sure you're positioned for it.